Rakshit, a very good afternoon to you. Let's talk a little bit more about, what the call at Marcellus is in terms of any strategy change. I mean, you guys have been active with regards to, some of these consumption stocks, looking at financials in a big way. What else?
So it's not so much a sector orientation that is a starting point for us. We want to pick up companies, specific companies, not sectors, companies which can deliver consistency of healthy fundamentals in good or bad times. It just so happens that India offers most of such companies in B2C consumption and financials oriented spaces. We do have one pharma company as well. Abbott is there in our portfolio, which is neither consumer nor financials. But the main construct and the main approach that has always remained, continues even now, is to stick to a portfolio which can deliver a very healthy earnings compounding over a consistently long and short period. So if you look at the second quarter, which was a September end 2019, the portfolio that we have, it delivered an earnings growth of about 14% on a weighted average basis, which is pretty much at the low band of outcomes that we expect our portfolio to deliver. So 14% in an environment, and this is PBT, by the way, this is not profit after tax. If you look at profit after tax, it's more like a 35-40%. I think more like a 40% in the second quarter. So with PBT growth of 14%, which is in an environment where I think Sensex Nifty PBT has delivered a -3 or -4%, if I'm correct. That sort of a resilience in a weak external environment is what we seek. Now, it's a separate matter altogether that in the current year in particular, thanks to the tax rate cuts, the profit after tax for our portfolio companies in the first half has gone up by about 40%. And in the entire full year as well, it should go up by somewhere around 35% ±5. So with that sort of a profit after tax growth, despite the fact that our portfolio has done 18, 20, 22% type of a return over the last 6-7 months, I think we are with a very good fundamental support on valuations in our portfolio, and that's where we keep backing the companies in our portfolio.
Rakshit, the last 1 month has seen a bit of a return to risk. I know your long-term portfolios, or if you have a really long coffee can strategy, it doesn't need to alter too much because there is a bit of a return to risk. Are you guys making any opportunistic bets? Something which was beaten down, but there could be a cyclical or a valuation-led up move that could happen because of the return of risk?
No, we are not taking any such bets. We like to be boring. We like to stick to quality. Quality by definition is 20% earnings compounding over 2, 3, 4 years or longer, even in a tough environment. So if we take risk, I mean, our view is that because we don't know how to time these risk on, risk off type of market events, if we take risk, I think we'll jeopardize a lot on the overall offering that we want our clients to get. And the overall offering is not just a healthy return, it's also a very, very low risk, very low volatility, right? So if we start doing that, then obviously it increases the risk in the portfolio without any commensurate increase in return, I think. And hence, last 1 month, we've not done anything. We don't think without earning support, risk on type of things can continue for too long.
Rakshit, so then for a stock like Z Entertainment, which was under pressure because of promoters pledging shares, now that overhang is out of the window. Fundamentals of this company, according to a lot of brokerages, they've said that it's intact. These are some external matters, external factors which are weighing on the stock. So you may not comment on Z, but would you look at companies like these now where the overhang is going out of the window?
Again, no, and the reason is, see, it's not really overhang around let's say, a doomsday scenario happening or not happening to a stock. For us, if there is robust fundamentals and there was some sort of an overhang around that robustness, which goes away, we are happy to look at it. Let me give you an example. So let's say something like a Page Industries, right, which is in our portfolio, because predominantly there was a massive channel financing issue, and hosiery retailers as a channel sits on a much longer inventory cycle, much longer working capital cycle, and hence the channel financing matters a lot to them. And they're also actually exposed to a lot of unorganized products in the basket of products that they sell. So a combination of both longer inventory days and exposure to more unorganized at a shop level for a hosiery store. Something like a Page Industries underwent a significant moderation in volume growth, earnings growth. Now, that sort of an overhang will certainly be there on a share price if we believe that the underlying beauty hasn't got diluted, which we continue to believe in this case. Then we might, we might increase our allocation a little, or we continue to buying. That's what we kept doing on Page Industries. We continued buying the stock. But other than that, a struggling franchise, and I'm not commenting on Z, I'm not commenting on any other specific name, I'm just saying in general, a struggling franchise, if the overhang around a doomsday scenario goes away, and if it doesn't become a consistent compounder, quote unquote, as in it doesn't become a monopoly which can't be broken down so easily, then there's no point in our philosophy to look at that sort of a stock just because an overhang went away.
Rakshit, just wondering, the tail risk of maybe a couple of financial institutions imploding and dragging the markets along with it seems to have receded a bit. In your research, do you guys, or when you are looking at things around, do you guys sense that as well, or are you still cautious about that possibility and therefore the impact on the markets coming about?
It's the latter. We are cautious about that possibility. When we look at the ground level situation, we don't see the financial crisis getting over as yet. So I won't say that the situation today in terms of the financial crisis at a ground level is any better than what it was a month ago or 2 months ago. So in that sense, we remain very cautious of the possible deterioration in the credit quality of various types of lenders given the current situation. However, we are exposed, we keep buying every day, three BFSI plays, 2 banks and 1 NBFC that we have in our portfolio. And the main reason for that is, to begin with, these companies are flush with liquidity on the liability side of the balance sheet. They are not witnessing any pressure on the asset side of the balance sheet, and most importantly, once the financial crisis bottoms out, then these companies will have the greatest ability to press their foot on the accelerator and increase loan book growth in areas where they're confident that not only is the asset quality robust as and when they lend, more interestingly, also there's a very low probability of incremental deterioration in asset quality. So once that confidence comes in that the external environment is not likely to deteriorate substantially from here on, I think the 3 lenders that we have in our portfolio, they will step up on loan book growth, and negotiating power being very high in a post-crisis era is a common trend that we've observed for the great quality lenders in 2007-8 or 8-9 type of a crisis, in 1997-98 type of a crisis. And if you look at the 10-year-old crisis, the 20-year-ago crisis, in the aftermath of the crisis, it's not the firms which could have imploded which benefited the most after the crisis. It's actually the firms which had the highest amount of liquidity access on the liability side and the best amount and the best capability of running a high quality asset profile, which benefited the most in the post-crisis era. And that's what we are waiting for. That's where we're hoping to see in our 3 companies that we are exposed to.
Rakshit, just one last question on this conversation. Do you feel that there is any sort of a contrarian trade that exists in the current market situation?
Sorry, contrarian?
In the
state.
sense which is not a consensus trade, something which is probably on the brink of something big.
Contrarian trade.
Yes.
I don't know which trade is quote unquote contrarian per se, but let me give you a couple of examples where it is non-consensus. So last 6 to 9 months we've had a consumption slowdown in the economy, where at least in the first half of the last 9-month period there was a perception that the entire consumption slowdown is because of lack of demand, right? So there were reports that 5 rupee biscuits are not selling, and there were reports that no one wants to buy cars anymore, etc., etc. I think a contrarian trade which someone could have made, and we did make, was that the bulk of this problem that we've seen in the last 9 months, not entirely, but the bulk of it is because of channel financing issues, and hence wherever, let's say, you had no channel intermediation. So a couple of examples being, let's say, retail players, right? Retail players, the likes of Trent, D-Mart, and there's a long list of listed retailers. Retail players who don't rely on third-party channel intermediation, or let's say something like an Asian Paints, a Berger Paints, where there's only one single layer of channel that too sits on a few hours of inventory rather than a few months of inventory.
Right.
In such a case, we've not seen a moderation in volume growth and revenue growth. So that's a contrarian trade which has played out, I think, will keep playing out, and similar examples. So buying HDFC Bank or Bajaj Finance today, I think, is a contrarian trade because the consensus will be that financial crisis is still ongoing.